Hello guys, and welcome back. In this video we are taking a look at Alphabet or Google, and this is a company and a stock that I really like. You can kind of see here in the 3-month chart that the stock has been falling, generally speaking has been falling, and it's down about 23%. Not too much compared to the overall market, but examining Google right now is very important because it's been doing great. Like, you can take a look at the 5-year revenue growth, and remember, this company is doing billions in terms of revenue. This is massive, 110 billion back in 2017, and now it's actually sitting at 257 billion. This is insane. I mean, this kind of growth for a company is absolutely tremendous, because we're not talking about 1 billion becoming, let's say, 3 or 4. We're talking about more than 100 billion, more than doubling themselves. And so, as you can understand, this kind of growth is absolutely tremendous, especially for a company of this sort that is actually a behemoth, is actually a massive company that is handling all sorts of our lives, really, all sorts of our daily matters in our lives. This is about YouTube, for example, videos, advertising, all sorts of things, really, emails. Google is everywhere, and there is definitely even more to come from them. And this company has been down more than what it is today, and I actually bought it some time ago. You can see that its lowest has been maybe near to 2100 or so in the past few days, really. But overall, I believe, and based on the financials, that it's relatively cheap, because remember, you may be seeing that the PE ratio of 21 is here and the 23 price to free cash flow, and be like, okay, this is more than 20, why is it cheap? The thing is, a PE ratio is almost like a consulting thing, but it's not the end all be all, because if you're buying a retailer like a brick and mortar store, you do want lower, generally speaking, you do want lower PEs and lower price to free cash flow ratios. They are not explosive growth companies, they don't have high margins. But a company like Google is absolutely different. And you can see that the revenue growth is absolutely tremendous even at these high levels. Same thing with the net income, even more. Look at this growth, this is insane. 5-year free cash flow growth as well. 5-year total equity growth that is growing tremendously as well. No debt, pretty much. And the company is also buying back shares. There are many things here, like the net income margin is absolutely insane. The return on equity is great without too much debt even. So imagine what happens if the company gets this extra debt. Now, they probably don't want to do that right now because interest rates are rising. But generally speaking, this company is basically a cash printer. And the only question that we need to be asking ourselves is it worth a buy right now? Now, in this video, I wanted to examine some things in terms of the stock news, and especially the upcoming stock split that you can see here. So the question is, what will Alphabet do after its stock split? Will it soar? Will it stay where it is? What will happen? I was looking at this interesting article here, and you can kind of see what the history shows here. Now, Alphabet plans to conduct a 20-for-1 stock split, which is going to be happening in about 20 days, July 15. They actually had one stock split in the past, and its shares didn't move much, so that may be a little bit of a factor here. Now, you will see here that unfortunately, Alphabet's stock split history doesn't give us a lot to go on, just because, previously it didn't really move that much. But generally speaking, what is happening? The question is, what is happening in terms of a stock split? How do companies react? So you can kind of see here, for example, that we can examine Amazon. What happened with Amazon? They didn't take off after the split as well. Instead, shares fell. Now, the Amazon stock split actually came, as the article points out, during a time when the overall market was struggling. So you could expect it to go down. The question is, what would happen in an overall neutral or even potentially even bullish market? In this case, it could be going upwards a little bit, but it doesn't mean that it's going to sustain itself, this kind of move. Now, the thing is, psychologically speaking, it's good for investors. Like, it actually propels them to buy more, because even though you can buy fractional shares, it's much more appealing to actually own an actual share and pay less for it. And it also makes it easier to do options with it, because it's cheaper, because you need to be buying at least 100 shares there. And so when we're looking at the stock split of that sort, it's going to be a 20-for-1 pretty much. And if we go back and check the price, this means that Alphabet or Google pretty much is going to be trading at this price divided by 20 really, which is about, well, like 100 or so, something of that sort, 130 or 150 or something of that sort. But okay, 115 it would be, not 50. But okay, yeah, the thing is it's gonna be easier for people to buy. So if it costs $115, then you can buy, let's just say 10 or 20 or 30 or 40 of them. But at 2300, some people may not even be able to buy just one, and they may not even be aware of fractional shares. So it could actually add some extra trading, some extra volume potentially from people who haven't thought of buying before, but now it's cheaper and they may actually be ready to get some. So that's one thing here that is worth examining. But at 2300 bucks, is Alphabet cheap here? Is the question. And we have examined, of course, Alphabet in terms of its financials. It's absolutely insane to see what kind of revenue growth this company has, like 41% last year. It's absolutely tremendous. Now, of course, this is not going to last forever. And typically speaking, the company makes maybe about 15 or 16, which is still absolutely insane for a company of that size. But overall, everything is green here. You will notice that pretty much almost everything is green. And if you take a look at the balance sheet here, you will see a very, very strong balance sheet with from 152 billion to 251 billion over here. Absolutely tremendous balance sheet. And take a look at this retained earnings, cumulative amount of net income pretty much added together, giving us about 191.5 billion. It's an absolute treasury over here at Google. And if you take a look at the cash flow statement as well, from 24 billion to 67 billion, these are numbers that are unfathomable, really. These are great. The only thing to ask is it cheap enough? Now, it's not going to be as cheap as we would want it to be, especially right now that it's been going up a little bit, but it's still pretty cheap. And this is why I bought Google. And if you take a look at these averages, of course, we're going to go a little bit lower. Let's just go 14, 16, and 18. Oops, let's go 18 here. And just try that out and see what we're getting out of this kind of revenue growth. It could be more, actually, because the company has been doing significantly more, like 23, 24, and 41. And at 14, 16, and 18, I think we're pretty solid over here. Now, the net income margins, let's go for 21, 23, and 25. Free cash flow margin, let's go 90. Maybe a 100 and 110, be somewhere in between. An annual return of 13%. And hit calculate. Let's see what we're getting. Now you will see that using these values, even our medium is a little bit off, but it's practically sitting at the current price. And the high is sitting at 3,000 right now, and the low is a little bit lower because of these values here, especially the revenue growth being relatively suppressed. This kind of discounted cash flow model will have a lot to do with the revenue growth of the company, because it has already been quite significant, and we are talking about already pretty high numbers that they need to be going up with the price in order to sustain this kind of price, this kind of stock price, really. But again, based on what the company has been doing in terms of averages, this is a conservative estimate. We could be having, of course, a slowdown. Depends on what is going to be happening in this current environment. But overall, for a long-term hold, I am actually fine with buying Google, even right now, as it's getting a little bit more expensive right now. I'm still fine with this current price, because remember, again, you're not getting a company that is like a slow growth company that's paying a dividend, that it's basically having low margins. This is a company with very high margins that are getting higher and higher, as you'll see here, and insane growth even at these levels. Amazing free cash flow, great balance sheet. All these things matter, and they add they add more value to the company, and you should be willing to pay a little bit more if that is the case. And with Google, this is definitely the case. And so this is what I wanted to talk about in terms of Google, basically. And together I wanted to examine what could potentially happen after the stock split. We're going to talk about it when it happens. Again, I'm going to be making a video, and we will examine what has happened in the first few days, of course. But it's worth examining the history of splits for Google and maybe get some idea. Generally speaking, I'd say it's a little bit of a coin toss. You don't know necessarily what's going to happen, although maybe in the first couple or 3 days there's going to be a little bit of a spike, I would assume. Then it could balance itself out. But overall, I think it adds at least some positive sentiment from buyers that couldn't buy previously, but they can now, and they may again not be aware of fractional shares. So This could actually propel the price a little bit, again, based on psychology and some potentially extra buyers out there. Thank you for watching the video, guys. I hope you enjoyed. Please remember to leave a like and subscribe. And remember that if you want to get access to this too, you can always become a Patreon. Take a look at the description link below this video. And I'll see you soon. Bye-bye.